Good morning, everyone. Today is March 26th. Welcome to the Sharpening session. My name is Josip Kosic, and please take a moment to read this disclaimer. We are not financial broker. Everything that we do here is for educational purposes only. And if you need to get in touch with me, feel free to send an email to either support or josip@redactive.com. And today we're going to have a session that is going to concern calls being exercised, and one even more complicated than that would be the assignments. So I'm bringing in here agenda for today's sharpening session. So the calls that are being exercised is something that quite often confuses a lot of people. And what I would like to do, I would like to share with you an article that is going to be available to all of you at our website. So I'm bringing here our website, and to find the article, one of the easiest way to do it is go to the tradewithufos.com/Josip. You can log in, or you can just simply scroll all the way down here. And this is where it says the books and articles. And when you click on the books and articles, of course, the books come first and articles would come at the very end. So we have some books that recommend about options and so on and so forth. And articles come down here. So there's one article that I publish on Tesla, and one that I'm going to put in a chat box now for all of you to look at is fresh out of the print. I'm putting here in the chat box, and if you can confirm it that you got it, I would really appreciate it. Is this article on a butterfly, and I want to emphasize that, as I said to you earlier, a lot of times when we are talking about the calls being exercised by the broker, there's a confusion. When can that happen? Well, if the long call is left untouched at the day of the expiry and the bell has rung on Friday, that call does get exercised regardless if the money is in account or not. So that's kind of strong statement, but be aware of it, that every time when you are along a call, okay, so let's talking about being just simple LC, all right, along a call, right? So plus means bought a call. We have a right to buy something, okay? What happens with that right at the end of the contract? Well, it gets converted into the ownership of 100 shares, and we're talking about the one single contract. So what I have done here in this article, I have wrote the article about the two cash settle indices. One is the RUT and one is the SPX. And that long call that I'm talking about, it's part of this complicated structure, a sophisticated structure called butterfly. So I said everything is here relative to something else. I'm going to compare the Russell 2000 with S&P 500 butterfly. And when you keep on reading this, I actually even included a hyperlink to that Tesla article that I just showed you. And here I'm showing what is happening at the Friday of the expiry. But the call that I really want to focus on is the call right here in figure 3. So I'm going to just zoom in here so you would see actually that I'm talking about that this 4,325 call, okay, that was bought. And as you can see right here, this plus sign, that's mean I bought the one contract. Now think about it. If this strike price is $4,325, and it says right here, cash secure index S&P settle at $4,328.87, right? What is that gonna do to my whole position. Well, if you can zoom in right here, this is now the expiration after the bell at 1 o'clock on that particular day. And what I'm pointing out to you that the price is right there at the $4,328.87. And in this column right here that says intrinsic column, that particular call that is long one, it's $3.87 in the money. So let's cut to the chase and point out to you what happened. What really ended up happening is that they went ahead and they settled that particular call in cash for the amount of money that is 4,325 times 100. And then they went ahead and then they converted it. So let me give you a better example here on the top. On the top, we have a RUT example. And the RUT example has a very, very similar situation. On a Russell 2000, on this particular trade, we also have a long call. This long call involves a strike price of the 2030. Okay? If I now scroll down to the top here and I show you that the price at the expiration on a Russell on that Friday has closed at 2030 and 72 cents. That 72 cents is the profit of the $72. So what does a broker do? Broker actually observed that that's a long call that is at the money, keyword at the expiration, and it's having a $72 of the value. Even if it had the 1 penny of the value, it would still get exercised. So in order for them to, as I mentioned this to you, convert this long call to the ownership of the 100 shares, they need to do what is called exercise. And in order to do the exercise, they will actually do simultaneous substitution and distribution. Okay, what does that mean? So observe over here. The figure 2 displays what really happened with that long 2030 call after it got exercised by the broker, because I purposely have left that, and that was my intention, in the account passing the expiry. So that amount gets multiplied by 100 because each contract controls, as I pointed out to you here earlier, 100 shares. So it's getting converted into ownership of the 100 shares. So to make the things real, what I did right here, I went into the Thinkorswim account and took a snapshot. And over here it reads, you bought 100 of the RUT keyword upon the exercise. Upon the exercise, right here, upon the exercise. And that 2030 call became a 203,000 because it's being multiplied. But then what happened instantly, the very next transaction in the Thinkorswim account, it says instantly it got sold, locking in this $72 of the profit. $72 of the profit. So what is really interesting here, and feel free to type in the chat box if you're following this, that although I did not even have money for that because it was a cash settle, the broker came up with their own funds and then just simultaneously sold my call and pay me the difference of the 72 cents. Pay me the difference of the 72 cents. So I highly suggest that you take a moment to read this article on Butterfly, because there's two examples, and I usually like to quote Albert Einstein because it says everything is relative to something else. So having said that, I'm going to now jump into the more interesting topic, at least for me, and that is assignment. And this assignment can get even more kind of, I guess correct word would be scary, if you don't know what the assignment is. So if we sold the call, that's mean in that case, selling the call obliges us to sell the shares, So what about if we have a dividend situation? And this is pretty much what I want to discuss now. And then the last part of the sharpening, I'm going to look up the big picture and talk to you um, about the market. So having said that, I want to just walk slowly through the whole concept of the first dividends. What is a dividend? Well, first of all, the dividend is something that company pays out as a sign of success. So companies pay the dividends to distribute the profits to the shareholders. And every time when a dividends is paid out, that is a sign of the corporate health, the sign that the earnings are growing and it's reassuring to the investor. So dividends are paid in cash to the share owners, but somebody needs to be long those shares prior to the dividend paid out. So if I now talk about an example and I want to really make this real, so just like I have shown you the article that I have written about the thing, I'm going to use an example that, let's say, underlying is trading for $15, and it drops before the dividend day. Okay, and somebody who is long 100 shares decides to, against these 100 shares, go ahead and say these 100 shares are at 15, and now the price is at price drops to 12. Okay, so this person who owns 100 shares, he decides to sell out of the money, let's say $13 call, while the price is at 12. Why would somebody do that? Because somebody is struggling due to the fact that price drops 3 points to $12. And this particular person wants to recoup some of the loss. And he goes ahead and says a $13 call. Now, I'm going to just talk about long call, give you the ability to buy the choice, but you don't have obligation. However, if that stays in the money, like in the example that I gave you, it gets converted into ownership of the 100 shares. With the sold call, that selling of the call, it gives the obligation to sell. And obviously, this particular person has 100 shares. So if push comes to shove, he can actually go ahead and sell it. So let's say few days later, stock rallies above $15. So if the stock rallies above $15, then those 100 shares are back to the entry price of the $15. But what has happened with this sold $13 call that is an obligation to sell? Did it become in the money or did it become out of the money? Because originally when it was at 12 and we sold it, this $13 call becomes in the money by $2. So if it's $2 in the money, there's also still some what is called extrinsic value, okay, or what they call the time value. Okay, so you have a premium that is composed of the intrinsic value, and in this case it's about $2. If we are trading now back to 15, if you're back to 15, It's $15. So let's say I'm going to price this particular call at $2 and let's say 90 cents. And the reason why I'm pricing $2.90 because the volatility and the time is part of it. So then this time value is about 90 cents. Could the person who owes this 100 shares with the sold $13 call in the money just before the dividend payout afford to hold on to that position? Well, the reason why I'm stopping here is for this effect that you might realize that if there is a dividend payout, and just see if I can actually grab here a sample of the dividend payout on one of the things that I picked up from, let's say, FinViz. On a FinViz, there's a section right here that says a dividend. And in this particular case, I was looking at the XLK, and XLK is the dividend of the $1.13. So why I'm connecting these two things together? Because in this particular case, the assignment might take place if somebody goes ahead and decides to call away the $13 call. So if somebody calls away that $13 call, okay, that's mean they wanna be owners of the stock, because just like I have pointed out here to you in this example, that this got converted to the ownership. When we sell a call, somebody buys a call, and that person who buys a call before the dividend day, he wants to be owner of the stock in order to receive that $1.13 per share dividend. You're like, but why would I get called away? Like it still has a time value of the 90 cents. Well, it can have a time value of the 90 cents, but what is really interesting, they're going to pick up the 23 cents, even though they called you ahead. And in that case, what is going to happen to somebody who is trading a stock? Well, they're going to get called away. That's fine. Now, let's make this thing a little bit different. And what I mean with different is, let's go over an example that originally somebody has traded that same XLK, which is what I have pulled up here, and it has a long $14 call. $14 call. If that particular person who has a $14 call, okay, decides when the price has dropped down to 12, so price drops to 12, this person now decides to actually turn this trade into a bear call spread, and it goes a big position on. So let's give example of the big position on. This is 100 contracts of the $14 call that are bought and $13 call that are sold. Okay, so we're talking about here having online $10,000. Why is it $10,000? Because this is a dollar, right, times 100. So you know what is going on here. If now I go back to this original scenario, that then stock rallies above 15. If the stock ends up rallying above 15, what is going to happen to that bear call spread? That bear call spread that has specifically bought to open $14 call and sold to open $13 call is in the money. So that right there might be a problem. So if that is a problem, then we need to look at the expiration. When is expiration? In this particular case, it's one of the old trades, right? So if this expiration is now on March 21st, what is the one thing that can possibly happen? One thing that can possibly happen is that, and I need to start giving some dates, okay? That on a few days before that particular trade, and I'm going back now in time and I'm dating myself, on March 17, which is just a few days before the expiration, one of those calls or three of those contracts could get called away. What do you mean it get called away? Well, that's mean you sold the call, and whoever bought the call due to the dividend payout decides to call away. And when they call away, they're expecting to get the $1.13, so they're giving up whatever the time value is. So now, in this particular case, how would that show up on a Thinkorswim account? The way how that would show up in a Thinkorswim account is that those three calls that are missing from this section right here would show up as a exercise call, and in this case would be negative, because when we are selling a call, we are taking up the obligation. Now, unlike the cover call that is covered with the 100 shares, we were covered here with this bought $14 call. We're covered with this bought $14 call. So what they have done here, they sold 300 shares at the 13, and when you look at the current price and multiply it, then everything makes sense, leaving this whole thing almost like what is called unbalance. So now let's talk about what is happening a few days later in terms of the balancing. In terms of the balancing, what is happening a few days later is following. So now it's 2 days later, it's March 19. And what really takes place is that on March 19th, we have a situation that our $14 call, the $14 call, and buying the call is a right to buy, is being utilized or it's being exercised. And I purposely started this sharpening with the word exercise because it's difficult to understand assignment without knowing what the exercise. And this 300 bought, here's a plus sign, at the 14 have covered that obligation. It's fine. Now, what happens with these other 97 contracts? What do you think is going to happen? Well, it all depends where the price is. If the price drops down, then nobody in the right mind is going to go ahead and exercise us, because they can go in an open market. They can go in an open market if the price is. So if back then XLK drops again to 12, if it drops again to 12, nobody in the right mind is going to trying to exercise us at the 13, so we can have a loss at the 14 and go ahead and do that, because they can go in open market, acquire the stock at the 12, and once when they acquire the stock at the 12, they're owner of the stock, because that's what they need to be in order to receive the dividend. So dividend is cash that is paid to the share owners, and in that case, the share owner is going to be receiving that amount that in that particular case was $13. $13. So although this trade had 100, at one point somebody decided to call away 3 contracts. Although there was no money in account, the broker has converted that into the sell, and then a few days later has used a $14 call, which was covering those $13 calls to finish this transaction. And then with the 97 bear call spreads, the price moved down and this thing came to an end. So having said that, I'm going to go back to the agenda and say, like, I talked about the calls being exercised, I talked about the assignment. And one more time, if you have any question about any of this, feel free to actually contact me at Josip. And also we have this section down here where you can ask questions. In order to ask questions, you can actually log in and then type in the question, and then we go ahead and answer the question about whatever the topic is. Having said that, I'm going to now open up the top. And when I open up the top, I would like to actually talk to you about the current situation with the stock market, because stock market has tricked a lot of people over the short period of time. So what I would like to do right now, it's called big picture. And one of the places that I like to do that is simply if I go to the monthly evaluation of what each of the exchange traded funds are doing. So I'm going to enlarge this Dow Jones Industrial Average ETF, and I'm going to point out to you that over here we are really looking at the monthly bars. And what is really interesting that in December of the last year, we have created a high that January monthly bar has pierced slightly higher. It has pierced slightly higher, and then it instantly has actually gone down for 2 straight months on February 224. You should remember that day. That's the day when this particular low was created on all the major markets, And what is interesting that Dow Jones did not create an equal low in March. In fact, what it did, it created a slightly higher low. Now, right now, it's simply encapsulated still within the February range. Now, if I look at that against the QQQ, I'm going to observe that that same, what I was talking about, February 24th low was slightly pierced. It was slightly pierced to the downside, and we ended up creating what I like to call equal low. So obviously the technology was weaker than the Dow Jones. And then we lifted, and right now we are still within the range of the February. Having said that, I'm going to point out to you one that is different. And when I have all 4 of them side by side, then you can obviously see that we have a January for a QQQ that is red, January for a diamond that is red, January for S&P 500 ETF that is red, and a January for the IWM that represents the Russell 2000 red. Now, what is interesting that the February is the only month out of these 3 that one of the major indices tracking ETF was in green. And when we came down to the February 24th, we actually start creating the higher lows, and we're just about ready to pierce through the high of the February. So when I look at this, you will see January red, February red, March green. Same on a SPY, same on a QQQ. But on a Russell, it is different because it already started creating the attempt to go higher. So it was the first one who tested the January and then bounced and stopped going lower. And then that February 24th low actually coincided with the low from the January. So I want you to be aware of it that the Russell 2000 represents the small capitalization stocks. So those would be small business. They're not like a big chip stock like a Dow Jones or the Fortune 500 companies in S&P 500 that are purely technology. Big names such as the ones in a QQQ. Russell 2000 represents the more companies than all of these 30 companies of the Dow, 100 company of the Nasdaq, and 500 companies of the S&P 100. And as of now, it's showing some resilience to the downside and attempt to go to the upside. Now, having said that, I'm going to pull up here options with options, and I'm going to go in options with options in order to evaluate where the Russell is in relationship to the 9-day exponential moving average. So I'm going to start from the top to the bottom. So this 9-day exponential moving average is something that I want to be focusing on. And when we are looking right here on a 9-day exponential moving average, I can make a claim that it's actually showing us a clear trend. We are currently going up. Now, we have a auto climate on a top, which is a trade-active option planner that shows us in terms of the calculation using the standard deviation for how many sessions have we been above this exponential moving average. So obviously you can see over here the number is 6. So we've been here 6 days above the statistically speaking, after the 6 days above the standard deviation, market, in this case SPY, should turn down. But we've been up 1, 2, 3, 4, 5, 6, 7, 8 days. That means we are slightly overbought when it's compared to the 9-day standard deviation. Now, sometimes the statistics are broken. Sometimes the market can do more than what is normal. But what I want to point out to you in this particular case, that if I put this information inside the statistics here for a big picture, that SPY had a standard deviation of the 6 and currently is up for 8 days. This is not necessarily the best possible time to go directional. So I would be urging you to maybe consider non-directional trades such as iron condors or something like that. But before I do that, I just want to point out to you this particular ETF that everybody pays attention to because it tracks the general market. It has a 6-day standard deviation statistically that shows up that the 6 days market tends to turn down, and currently we are 8 days up. So that there's a high chance that there might be a pullback, but then we shouldn't be shorting it when we are above the 9-day exponential moving average. So I'm going to now move to the IWM, and I'm going to observe what is the situation with the IWM. On the IWM, I'm using the same approach because I'm looking at the 9-day exponential moving average, which is pointing out in a top chart, versus down here on auto climate that it's tracking using the standard deviation, and it shows you the count for a standard deviation is actually 4, and currently we've been up for 7 sessions. So there is a possibility that the leader might be heading slightly lower. And from this high right here to this high, we can actually draw somewhat downtrending line. So I'm going to switch this on a daily so you can actually see what is going on daily. We're coming into what? We're coming into a set of the UFOs. That means that there is a possible pullback that can take place. And the one that had been leading, and I'm going to go back over here on the bigger picture because right now I'm comparing daily with the bigger picture. This is the one that had the green monthly bar, and it's coming into the resistance. It's coming into the resistance. So it's very, very possible if I now connect these dots from the top to the bottom that price action might be ready for a pullback. So if the leader who is supposed to be leading us up and it's coming also to its February high, there might be possibility for a trade to the downside. Now, there's another thing that I want you to look at when you're using the Tradictive Option Planner, and that is what are the options doing, and specifically on IWM. On IWM, we have a blue line that represents the call activity, and we have a gray line that represents the put activity. And right now, both of them are pretty much sitting on the top of each other. So we can hit this either with the bear call spread, or we can hit this with a more complex structure, such as the ones that I was pointing out to you in one of these articles. So, for instance, over here in this article that I have written about the butterflies, I have even included a hyperlink. Click here to the hyperlink, which is going to open up the trade on Tesla. So when you click that particular thing, it's going to bring you to the article down here that is on a Tesla. And that structure that I have done on a Tesla is a broken wing butterfly, right? This broken wing butterfly is a call butterfly, but I like to call it a bear call with the built-in protection. So this call butterfly is actually composed of the two verticals. It was composed of the bear call spread and the built-in, the bull put spread. Okay, so we can now, in this remaining time, consider on the IWM placing one of those broken wing butterflies. But the key thing that you need to be aware of it, that the one needs to be wider than another, right? So that's mean that the bear call over here was wider than the bull call. So having said that, I'm going to be now considering on the IWM, I'm going to be considering for the next week placing a bear call spread with the built-in bull call. So I'm opening up the option chain for IWM. So when I go over here under the expiration, we have a different expirations that are coming up. So we have a March 28th expiration, then we have a Wednesday expiration, and then we have a April 1st expiration, April Fool's Day. Or we have a April 14th, which is a regular monthly option. I'm going to actually select this for April 1st. So I'm selecting the April 1st. Now I do need to revisit the chart. So I'm going to just float this for a second and move out of the way so we can revisit the chart. And on IWM on a daily, we're going to observe that we have here UFOs that are above us. Now, one of the things that I like to do when I'm looking at possible building the trade is simply to entertain what I'm going to actually do. So we're currently at 206. So what I'm doing right now, I'm starting now building the trade by explaining what I'm doing first. I'm looking at the out of the money 209 call that I want to buy. Right above it, I'm going to be then selling also out of the money 210 call. Now you will notice that this is a dollar difference. But what I'm going to do on the top, I'm actually going to be buying 212. So then at the end, the way how this whole structure is going to look like is going to be that I'm long 212 on the top call. On the bottom, I'm selling 2 of the 210 calls, and I'm protecting myself with the 209, what I like to call the bull call spread. So let's build this particular strategy. So what I'm doing right now is I'm going into the option chain for April, and I'm going to be now selecting what is called a bear call spread, and I'm going to be adding to the bear call spread extra leg. So I'm selecting the bear call spread for April 1st. So we're going to be selling the 210. So here's a 210, and here is 2009. Okay, now I'm going to add additional leg. That additional leg is going to be bought. Okay, so to make this kind of thing simple, I'm going to just alter this the way it should read from the top to the bottom. Okay, so here we're going to have 2 contracts of the 210, 1 contract of the 212, and 1 contract of the 209. And I'm going to click OK. And now when I get this, I'm going to take a snapshot and put it inside the Word document here. So when I put inside the Word document here, it's going to be so much easier to understand why I call this non-directional trade, because it's very simple. It's a bear call spread that expects nothing to be done. So on IWM, we're currently sitting at the 206. Obviously, 209 call, it's out of the money. 210 call, it's out of the money. 212 call, it's out of the money. So all of them are out of the money. But if we go up to the UFOs, unfilled orders that are sitting here at the 210, and we actually close at the 210, what would be the outcome of this particular trade? Okay, so let's talk about now the outcome of this particular trade. So at the entry, we are at the 206. But when we come to the expiration, and we are now looking at the 3 legs at the expiration. So we're looking at the long 1 of the 212 calls. Okay? Short 2 of 210 calls. And also long 1 of 209 calls. 209 calls. Now it's expiry. Closing price is 210. So we're now at the expiry at 210. Let's now evaluate what is going to be if we are now at 210 at the expiry with this 212 out of the money call. It's going to be out of the money. What is going to happen with this 210 if we are exactly at 210? It's going to be out of the money. What about this 209? It's going to be in the money by what? By $1. How much did we make on this trade? This negative 13 means we got the credit of 13 cents. So this whole trade, if the price goes to 2,210, is going to make us 113. Now, the question becomes, how much did we risk? That's why we need to go to Trade Active and build this trade one more time from the beginning to the end and make sure that you follow what is being done. So I'm looking at the IWN. I'm building it from the bottom to the top. Bear call spread. It was involving the expiration of the April 1st. April 1st expiration. We were selling the top at 212 because it's out of the money. We are selling two of these at 210. So 210, 212. That is a $2 spread. Over here is a what? $1 spread. So we're buying one, that is $1. Over here is $2. So now when I click here OK, it's gonna add up, and then I'm gonna go to the risk graph. And inside the risk graph, it's gonna calculate how much money actually this thing had that we can actually put into the worksheet and explain it. So when we did this trade for 13 cents, while the IWM was at 206, we were risking only $87. And if everything works out and we reach the 210, then on an investment of the $87, we have actually made a profit of $1.13. So when you divide these two numbers, in that particular case, the outcome is very, very good. So what I'm planning to do right now, I'm going to actually put this into the paper trading account. I'm going to put this in the paper trading account. So when the market opens, we can actually place this particular thing for the next week. So just give me a second. I'm logging in here in the paper trading account, and I'm going to show you how this thing works in the paper trading account. So here it is, and I'm going to select out of two accounts, one of them that has less money. So this is one that has less money. We're going to go into the IWM, and we're going to make this thing real, so it's not theoretical. So IWM, we selected April 1st. We are on a call side, and we are looking at buying the 209 that has a lot of activity. As you can see here in terms of the volume, I can actually look at the volume and, well, I have three columns here. Let me just explain this to you. I have three columns here, and those columns are volume, intrinsic value, and open interest. So if you're just looking at the intrinsic value, obviously everything on a call side above the 206, because we're currently sitting at the 206.12, is out of the money, out of the money, out of the money. So if I'm buying the 209, that's the one that I'm considering buying. If I'm buying a 209 and then selling two of these 210s, right? I then need to have a protection, and protection is 212. So let's build this. So I'm clicking right now here on 210. I go where it says buy, and this is called butterfly. So I'm buying 209, selling the 210, and doing the what? 212. Now I also want to point out to you that I purposely keep this on these 10 contracts, so it will slow me down. So I need to adjust this. So now I'm adjusting this to 1 for the 209. For a selling, 210 is a 2, and for buying is 212. There's that 13 cents credit. Now, when I click here, confirm, I want you to take a moment to look at it. These are the same pieces of information that the Trade Active has given to us, okay? What is the break even? Break even is 211.13. And I need to come back and emphasize this till it really sinks in. So just like this is right here, explanation, this should be explanation too. So let's move this thing to be side by side so we can have it all on the same document and observe what is happening. So while the IWM is at 206, we are doing this particular trade that gives us a break-even point of the 211. Now you're like, I don't understand this. Okay, so let's talk about this. If we pierce this by $1, could we go to 211? And then where's this additional 13 cents come from? From the fact that we are placing this trade for a 13 cents credit. So having said that, could this go even into the UFOs? Yes, it could. So I'm sending this in. And when I send it in, of course, the market is closed on the Saturday. You're not going to hear anything. But I'm going to go here on account and position side, and I'm going to show you that it's tying up only how much money? $87. Why would be tying up $87? Because Trade Active actually showed us that maximum risk is $87. So we could have a situation that this thing actually moves even inside of this area and we're still profitable. But we're going to be most profitable. We're going to be most profitable if and only if we drop to 210. Drop. I mean, a rally from this 206 to 210, and then expiration comes in at 210. So when it comes to 210, my 212 call that gives me the right to buy at what? At 212 is going to be out of the money, because at expiration, if you're at this level, then why would anybody want to use that? My 210, if you're at the expiry at 210, is still out of the money. Now, it would be different if it was 1 penny in the money. If it was 1 penny in the money, then you have a situation that I show you in that article that I got to sign even for the sake of the 72 cents. When I started the morning, I was actually showing you this article on a butterfly that because of the 72 cents, what did the broker do? They went through all that trouble putting $203,000 and then selling it for $203,072 because they what? They owe me that $72 and then they give it to me. So if this was in a penny, even by a penny, then you would consider that not out of the money, but then that would be at the money. And that would be at the money by what? By a penny. Okay? So in that case, that would happen. So then you're like, well, but you would still be profitable, but it wouldn't be any more $113. It would be $112 because of this 1 penny is $1 when it gets multiplied by 100, right? So this is a trade that I consider non-directional. And the reason why I consider non-directional, because we have done this evaluation of the market, and a non-directional trade means very little expectation of the, in this case, IW movement. So if we go down, let's talk about that scenario. We don't end up going up. We actually go exactly where this line shows, down. What's the damage? There's no damage. Why is there no damage? The reason why there's no damage, for simple reason that we did not do, we bought, but we bought for credit. And the reason why we bought for credit is because my spread, working order, there it is, my spread of the bear call is $2 while the bull call is only $1 wide. So that $2 minus 1 means I'm risking $100, but wait, isn't the bear call giving me more money than my bull call is costing? Yes, and that's the difference of the $13, and $13 is a plenty of money to pay even for commission. So in that case, if the market doesn't do anything at all and just starts sideways, or even as I pointed out here, go down, I'm fine. If it rips, be aware of it, then the whole butterfly, broken wing butterfly, is going to expand, and we would need to then manage it. And that's why I was pointing out to you that if you would take the time to read this article on a Tesla, because that Tesla was really managed in such a way that had unwinded one side. See over here, if you're looking right here, I'm exiting the one side and keeping the other side on. Yeah. So you see over here when it says a close, I'm closing the one side. And then at the end, in the article, I said, look, and this is what happened at the tail end, and how much was the whole thing. So I break it down into explanation of what the bear call was, what the bull call was. So take a moment to read this, and again, if you have any question, I would be able to answer it at tradingwithunfilledorders.com. Or you can ask the question, scroll at the bottom where you find everything. So let's recap everything that we have done today. What we have done today was very simple. We started the session by talking about the exercise. Can the call get exercised by the broker? Yes, on a cash secure index such as a Russell 2000 or S&P, it could. Be aware of it that IWM is not cash secure, okay? Which means the broker a few minutes before the bell can actually go in and exercise you. And in this article that I have put in the chat box, and thank you for replying that you got it, you can actually take a moment to read it and to realize that you don't need to be afraid that broker might actually do that. So, let's see here. Okay, call broken wing butterfly is one of those tactics that can be trading knowing with certainty that broker will not exit them on your behalf in the last 2 minutes of the trading, even if they are at the money, as long as they are cash settled, such as RUT and SPX. Now, before you get promoted to trade the RUT and SPX, I would highly suggest that you trade ETFs such as SPY or IWM. But be aware of it. This is the last point. This is my golden nugget with which I want to leave you, is that if by any chance this is in the money, few minutes before the expiration or half an hour before the expiration, it's better for you to exit the whole thing, exit the whole butterfly. And I can show you how to exit the whole butterfly once when it's filled. You would single right click on that thing, you would go opposite order, then you would lock whatever the price in and you would send it in. Okay, this spread is so tight, that you can even use a market order. It's really a matter of a few cents. Now, reason why it's showing the 6 cents, because currently market is closed and they widen it. But you saw the liquidity on these products. Liquidity on these products, when I was showing to you open interest and volume, was in the 4 digits. And I usually just look for a 3 digits. So having said that, I'm going to bid you a good day. And thank you once again for attending this session. This session was very informative. We have covered what can happen to the call when it's being exercised, what can happen with the call when it gets the sign. I have given some examples. Then I went over the big picture. I have concluded on the big picture that due to the current situation, this is really not a directional trading market. I selected the IWM with a very little expectation of the movement. And I concluded that if you're trading the IWM, make sure that you hedge yourself and monitor because last thing that can happen to you, that you're waiting for this to be out of the money exactly at 210, and then the broker in the last minute comes in and messes you up and exits you. you should better exit yourself than let the broker exit you. Okay? So once again, thank you for attending this session and have a good day. Stay hedged.